This next chart, we've heard a lot recently that, wow, inflation has dropped a little bit, maybe things have peaked. Well, there's been some early signs pointing that we may be at a peak. When you look at this chart, you can see where the red circle is, that we've had a few months here, very strong increases, but actually at the end of July, we've seen a little bit of a softening or a stabilization of inflation, which is good news. However, it's not enough data to really say that, hey, things are at a peak. We're going to have to watch this for a couple more months and see how the numbers come in. But yes, the July numbers are looking better than what we saw in May and June. Now, where do we think inflation is going from here? Well, we expect that the headline CPI inflation to the end of 2022 to end somewhere between 7 and 8%. If you think about that long term, Dan, that is very, very high. That's 3 times the normal, what we would call a stable inflation rate of about 2.5%.
Yeah, that's true.
And that's what the Fed target was. So very, very high throughout the rest of this year. However, we do see it falling about in half throughout next year in 2023. So the current signs of peaking are encouraging, but the Fed must stay on course to fight rising prices because there's still things out there that are driving inflation and keeping it at a high level.
Well, you know what, Rocky, it's kind of interesting, and maybe the clients are thinking the same thing. When it comes to year-over-year inflation, so we're going to be backing up against high inflation as it was coming up.
Right.
Are we going to be seeing inflation come down relative to that, or is inflation actually coming down?
That's a good question. When we're looking at the data, the projections, and they are just projections for next year, it is real inflation coming down. So we are expecting it to drop. We believe the move the Fed is making now is slowing the economy. And as we're pointing out in this chart here, the potential inflation impacts, basically the Fed has to stay on increasing the Fed funds rate so that they can hit that target of 3.25, 3.5 by next year. They're also at the same time unwinding their balance sheet. As you can see in this chart on the left, the Federal Reserve balance sheet is expected to go down. That's their purchase of assets they've done since COVID to try to stabilize the economy so that stock values and bond values remain strong and companies didn't go into default. Good move then, but they are still sitting on a lot of assets. As they unwind those and put those back out on the market, that increases the supply, which tends to lower demand because more becomes available. And so they need to do that so that they have some, what they call bullets in their gun for the future, that if things don't get under control, they can start rebuying and repurchasing and use that tool along with reducing future interest rates. But right now, everything's still fighting inflation and trying to slow the economy enough that it can stabilize. So as you can see here on the arrows, we expect long-term interest rates to continue to go up through this year. They're going to have to continue to move and keep moving pretty aggressively as they have so far this year in order to get inflation down and slow the economy. As a result of these moves, we expect growth to slow. It is going to slow down. We've already seen it, Dan, in the housing market. Finally, there's been some reprieve in what's going on in house prices, and the values and things like that are starting to stabilize. There's less and less mortgages, less and less new home starts moving forward. So we are starting to see the effects of a slower economy. We aren't seeing it on the unemployment side. Labor is still very, very high in demand. As the economy slows, we expect that to change and unemployment actually to go up. So this is kind of where we see things going over the next 6 months or so. But we're going to keep an eye on it as things move forward. So
Wow.
I hope that education was good for people.
Well, I mean, it helps me, it helps everybody, I think, understand, get a better feel of what's going on and what's affecting things out there. It will be interesting to see what happens moving forward, because at the end of the day, you know what, we're kind of at the mercy of what the administration does to kind of bring this back in line again.
Right.
And you mentioned what the feds are doing, raising rates, which it certainly is slowing down the housing industry. There's no question about that. But at the same time, it kind of has an inflationary aspect when it comes to businesses having to borrow money, because
Yep.
again, bigger expense, pass the expense on to the consumer. So they've got a tightrope to run here to make this work. So we'll see what happens.